For the last 25 years, I've been in real estate, which is my passion. Back in 2015, I started working in the family office space directly for several prominent families on their real estate portfolios. With 70% of families losing their wealth by the second generation and 90% by the third generation, I then realized that real estate would be the missing component for families, allowing them to maintain their legacy and mitigate how much wealth is lost for future generations. It was shortly after working for my first single-family office that I started interviewing successful real estate families and industry experts. These conversations, combined with my first-hand experience of working for families on their real estate investments and currently investing on behalf of families, that has allowed me to share this knowledge with other family offices, family members, and family office professionals so they too can be good stewards of wealth. I'm DJ Van Kuren, and this is Family Office Real Estate Insights from the Family Office Real Estate Institute. Thank you for joining us at another episode of Family Office Real Estate Institute interviews. I am here today with Rick Courtney from Essential Realty Partners. Rick, we're going to be talking about a great topic today having to do with dislocated markets. Thanks for being on the show.
Oh, thanks, DJ. Always a pleasure to see you, my friend. Aside from our various travels where we hook up quite often. So good to see
right.
you.
Exactly. So let's talk about this dislocated market issues. If somebody were to come up to you and they said, how would you define that? What would be a definition of this dislocated market, and how does that play in today's environment? What would you say?
Well, I think that's exactly what we're in today. And we define that as markets that are experiencing the financial system is experiencing stress that causes mispricing of the assets. And, obviously, as you're very well aware, DJ, the Fed's, embarked on a rate increase program that's, unprecedented in the last 40 years or so. And it's caused a great deal of stress on property values and, some of the financing options available to owners and operators out there.
Yeah, we've seen a lot of changes, whereas the loan to value has come down, right? And then,
absolutely, yes.
Of course, the biggest thing that I've seen out there is this interest rate. We've had a lot of people, especially in the multifamily sector, right? You had a lot of people that were expecting, I'm going to buy at a 5 cap, I'm going to sell at a 4.5 cap. I've got 3% interest only, and then I'm going to refinance out at 4.25. That's not happening today, right? And all of a sudden you're having this negative leverage. So tell me a little bit about what you're seeing today compared to what you've seen in the past from your experience.
Well, it's, I've been in multifamily since 1984. So next year would be my 40th year in the industry. And, that provides some unique insights in that I've been through multiple cycles. And I'm trying to compare this one with other cycles I've been through. And I think this one comes close to the one that I experienced in between 1986 to the early 90s. And that one was sort of manufactured by the government with the flip-flop in the tax laws. The cycle that we're going through now is very similar, in my opinion, because it's sort of flip-flop on the interest rates. We've gone from a zero interest rate policy during the pandemic with loads of stimulus to now, unprecedented tightening, as we just spoke about a moment ago, not seen in 40 something years. And it's caused a lot of stress in the marketplace. And, one example is floating rate debt, where they were setting, with a pay rate of 3.5%. And now those pay rates are up close to 7.5% to 8%. And operators just didn't budget for that. And, it was, I think another example, if I have to use one that shows just how extreme the flip-flop has been, is not only when you have floating rate debt, not only are you exposed to these type of increases, but most lenders require you to hedge that debt. And I know during a presentation that I gave, I used an example of where I was quoted $100 million notational value. Well, you could have hedged that $100 million notational value in 2020 for 68,000 a year. That same hedge today is 2.2 million, and that's just for a hedge. And so we're looking at a multiple of in that case close to 20 times. And most operators again just simply did not budget or foresee anything of the magnitude of the shift that we've seen in interest rates.
So I want to talk a little bit more about this hedge. Explain this to me a little bit more about how it works, when you put it in place, and some of the details.
Well, a hedge, for example, let's say that you and I, we buy a property and we take out $100 million on that property and we have a pay rate at 3.5%. Well, the lender will have a certain debt coverage ratio on it where we have $1.25 in income that covers every dollar that we have in debt service. Well, the lender will calculate that once we get close to, if the interest rate goes up, where we get close to having to pay that extra 25 cents that we have as a cushion in that debt service coverage ratio, that we offload that risk to another third party. And that's what a hedge is. It's usually one of the bigger banks out there. There are regular players in the market, and they will come in, and anything that is the difference between, let's say 2% is our hedge. So we start out 3.5%. If our interest rate goes to 5.5%, that hedge provider will come in and pay the difference above that 5.5%. We're on the hook for the 2%, but the hedge provider is cutting off our risk and our downside beyond that.
I mean,
I hope I was trying to explain a rather complex mechanism.
That explains it. I guess the question comes in then is that, and I'll tell you this hedging perspective, and this is one of the reasons why I think we're starting to see some of the stress, and we're going to continue to see more distress, is because, I'd always say that if you couldn't make money in multifamily since 2012, you shouldn't even be anywhere near the real estate game, right? And then you have a lot of people that are touting, over the last 10 years, we've done this. Over the last 5 years, we've done this. Well, everybody's been able to do that because that's just the way things are going. And they don't have that knowledge of these hedging type structures, right? And so that just adds more to the problem and just shows how inexperience can make a big difference.
Oh, absolutely. And, I've been in the market, obviously, and intimately aware of how these hedges were perceived. They were perceived as an afterthought in the financing. And, it was like a nuisance charge up until 2021, when some of them started, the latter part of 2021, when some of them started to get anxious about them. But, as I mentioned earlier, you and I go to various industry events and conferences, and, it's sort of shocking out there how many operators are a little bit behind the curve on, having to replace these hedges, because a lot of times they're not coterminous with a debt. For example, you may take out a loan for 5 years, but the hedge is only good for 3. And so you have to replace that hedge. And, it's to say it's sticker shock is an understatement.
But so that's like you're going to have the repricing at that time of that
absolutely,
hedge.
yeah.
Okay, so if you can't go out that far, then I mean, in many ways, it's the same thing as if you're going interest only, and then 4 years from now, when you have to convert to a permanent loan, the rates go way up. So then where would that hedge really be beneficial if, let's say you have an interest only loan for 5 years and your hedge is only going to allow you to have a buffer for 3 years?
Right. Then you find if it's not coterminous with the debt, then you find yourself between a rock and a hard place.
Mm.
Your options then are, you're trying to look at the best of bad options. You either the sponsor has to step up with cash in. They have to do a capital call with their capital partners, or, they have to do a combination of either of those two things, along with diverting the cash flow that was being distributed to the capital partners, diverting that back into covering that hedge cost. And it will wipe out the entire distribution. So some deals that were paying 6% cash distributions, or say up to 8%, that that's totally wiped out in these circumstances.
So have you seen any difference in this of where we are today compared to the other times in your career? Does it look like the same movie? Does it look like a similar movie, or it's a total brand new movie?
I would say, as they say, history doesn't necessarily repeat itself, but it rhymes, and that's certainly the case here. We know that real estate is cyclical, and most of it's driven by fundamentals of supply and demand. In this case, we have a different instigator of this cycle, and that is the capital markets, and that's the flip flop on the interest rates that we've been talking about. So I would say if there's a difference, it's supply and demand. Usually drives cycles. We get to the situation where we overbuild, get a little bit too much supply, and then prices start softening. In this case, it was totally driven by the interest rates. The long-term fundamentals are still in pretty good shape. We do have some weakening in them, but long term they're fine. But in the short term, we do have some weakening, and in conjunction with what we're talking about today with the interest rate environment, it's it's going to combine to probably cause quite a bit of pain for folks that especially bought with floating rate debt from 2020 to 2022.
Yeah, you said something too that I've been preaching at a lot of these industry events that you speak about, where we do see each other. Real estate runs in 18-year cycles, and you can go back 250 plus years in the US, the UK, Australia. And it's just like you said. It's like we don't learn from what's happened in the past, where, nobody's building till it gets to the other end of the cycle where there's too much building, right? And so, and then we go into a recession. So, and the other things that I've been saying is, yes, the fundamentals are still there. You still have a huge demand for multifamily going over the next 4 to 5 years. You have here in Denver, for example, there's not enough homes in order for the people that want to buy them. And so what you have is, you have strong fundamentals, but I don't see a recession until 28, 29. So we still have runway, but we also have that opportunity because of this interest rates that have happened, right? So it's one of those things where you can't say it's a demand issue. It's more of a management issue, I think. Would that be safe to say?
I think so. It's on the capital stack side, how you structure your deal in your capital stack. And the deals have to reprice to take into consideration today's available capital and the interest rate environment. It's a situation, DJ, where right now a lot of the risk is that in the private market the deals are still overpriced, and we're seeing that correct itself. And what we're seeing right now, I think, is a reversion to mean. I know everyone is talking about look at how high interest rates are, but still in the multifamily market, we're in the mid fives, on 5-year debt out there. And when I got in the business before multifamily in '84, I got in 1980. Home mortgages were 26%. Now that's a high interest rate. 5.5 is not high, and In my estimation, that's more of a reversion to mean than it is, sky high interest rates. So, I think what we're seeing right now is just a correction in the market.
Well, I'll tell you, and it was in the Wall Street the other day. It's like the highest change or something in 22 years. I mean, it's a significant amount of time, right? I mean,
Oh yeah,
time's
yeah.
sort of gone by, but we've continued to see this uptick. Okay, so I want you to put on your investor's hat, right? So now I'm going to ask you some questions where you're, a principal of Essential Realty Partners. All right, so you guys are going into multifamily. You're looking at opportunities on multifamily. Now, here is the question: is that how do you prepare for this type of situation? And before it happened, right? So before going into the interest rates, how should people have been looking at that? And then how should it be looked at as today to say, oh, geez, now I'm in the middle of this. So it's a big question, but you can break it down in two parts.
Well, a lot of this goes back to what you were referring to earlier, is the experience of having lived through these cycles. And as you mentioned, since 2012, literally, you could have thrown a dart at any multifamily property out there and made money. They say that about stocks, but also true. When you have a declining interest rate environment and compressing cap rates, it's hard to lose money. The difference with the folks who have been through the multiple cycles is that they understand how abruptly things can change and how black swan events can happen. I mean, we all saw that in 2008. We're seeing it again, with the interest rates ratcheted up during the current program. And so you need to make sure that you're modeling into your business plan sensitivity analysis that says, under given scenarios, what is the worst that can happen. And so you need to make sure that when you go in and structure your transaction, that you're mitigating as much as possible the downside risk. And the way to do that is to make sure that you factor in, for example, what should have been factored in. And what we were factoring in when we were looking at deals in 21 and 22 was, what happens if rates normalize? That's what should have been factored in. And if you ran that sensitivity analysis in your underwriting and incorporated it into your business plan when you're acquiring these assets, you would have seen that on a risk-adjusted basis, the risk wasn't, the reward wasn't there for the risk that you were undertaking. And quite frankly, that folks that were running that kind of scenario probably weren't very active during those years.
Yeah, we had actually at the Family Office Real Estate Institute Exec Ed program, we had a couple of months ago at the University of Denver. I actually did a case study on that. And it was a matter of, okay, you got a stress test. This is what somebody's coming to you with a deal. You're going to be you're this family office investor that's coming in, and everything's pie in the sky. Is it a good deal? Do you take that? And what was really eye-opening, I think, for a number of participants there is they say, okay, what happens if cap rates go from 5 to 6? Right? Let alone 7 or 8. And the significant difference, what happens if the interest rate changes from this to that, And these even should be questions that investors should be asking developers. And quite honestly, operators should be bringing that, I think, to the investors to say, look, we've already modeled this out. We've been working on a deal down in Texas. I don't know if I told you, but we actually redid all of our models up to a 9.25. We looked at the forward curve. Now, this is more of a modular mobile home type deal, but that's pretty significant, and what did it do and what did it happen? And, that's the one thing with Sam Zell, who unfortunately left us a number of months ago, is that he'd always focus on, how do I protect my downside? And that's really what you need to do.
What's your thoughts about leverage on interest rates or on properties? Because, what we saw before going into the recession was that people were just over leveraged tremendously. Now we didn't have that here. We're starting to see more preferred equity that's coming into the market, and families have been doing that, quite honestly. But what's your thought about debts and where the percentage of debt we're restricted because of what banks are providing? But let's just say in general, do you think that there's a certain amount of debt that should be always maxed out at on a property? What's your thoughts on that?
Uh, no, I don't think that. I think that each individual property is very unique. As you're aware, it's not homogeneous like the equity and credit markets. Each individual asset has its own physical and market location attributes. All that being said, I'm a proponent for very conservative structuring during a down cycle. Uh, even though you've been through these, there's no way to predict the future. As we said, they somewhat rhyme, but you have to provide yourself with some cushion during these periods of stress. Understanding that there is a light, and once you transverse the trough of a cyclical downturn, that you're going to do very well. But you have to position yourself to make sure any unforeseen shocks while you're in the down cycle itself you can withstand, or you're not going to be successful in being a contrarian investor, or be successful in investing in a dislocated market. So we're very conservative. As a matter of fact, we're dealing with some joint venture partners right now that we're writing into our joint venture agreements that we can't employ more than 60% debt on the deal. So and right now with the pricing where it is, DJ, most folks, the agency financing is still relatively available, but even on that, the loan to value is somewhere around 55 to 60% on that. Now, all that's rectified if you're buying the property at prices where they should be on a risk adjusted basis. And, that's a whole different discussion of, where should prices be, given historical indicators relative to the interest rate environment that we find ourselves in today.
So, it's funny because the first patriarch I worked for absolutely loves leverage, continues to, and so he's had tremendous returns, and I mean he's built a significant portfolio, and net worth over that period of time. However, I will also say that he's the most analytical real estate guy that I have ever met, right? So he's in a better position to be able to do that because of the information and how he looks at things and whatnot. But when you can utilize leverage, investors love it because it enhances returns. However, when you get into a downturn, if you were to ask them, they'd say, I wish you were at 60% instead of 85 or 90%. Right. So it's one of those things where, and once again, why are you only at 60%? So it's one of those things that you're going to stay the long term if you are more conservative, and you just have to, make sure you educate why that is and whatnot,
Yeah, leverage is very much a double-edged sword. We've seen a lot of wealth created using 85% leverage over the last 12 years or so. And when the music stops is when you get on the other side of the blade, and that's what happened after the first quarter of 22. But we're seeing a lot. You had mentioned preferred equity. We view preferred equity as debt. A lot of it that we're seeing out there. There's a difference between what we call soft pref and hard pref, and some of the hard pref has current pay rates that are, double digits right now. And if you don't meet it, they can take over your general partner interest and, and then take you out of the deal. So, sponsors can be foreclosed out of their deals. So we view a lot of the pref debt, from some of the debt funds out there as debt.
Yeah. Well, the reality is it's really a second mortgage. I mean, if you think about it in many different ways, from that perspective. So how do you capitalize on the market today?
Well, we always, I think one of the things that, I saw a proliferation of, and during the last, I would say 6 to 7 years, is that multifamily was considered an investment analogous to bonds, for example. And investors were going in, or some sponsors were going in more from a passive perspective, forgetting that, real estate is actually what you're buying is an operating business. And it has its own physical characteristics. It has its own market characteristics, and the challenges that are associated with each one of those. And so, we're going to see a lot of folks who were not prepared as operators get in trouble during this period also. If there's one focus that or one area, I would say, that we focus on during a downturn, it's operations, making sure that the asset is absolutely running as efficiently as possible. And as you're aware, there are some significant, operating expense anomalies, we should say, out there in the property taxes and the insurance and things of that nature that are also causing stress in the marketplace. So all of this stuff has to be taken in consideration as you move into the trough or the downturn of the market. You got to be a skilled operator. And that's number one. You're looking for assets that have that operational upside. Maybe it's been neglected, or maybe the skill set wasn't there from the previous owner. Those are situations that we're looking at for Essential, for example. We want to make sure there's operational upside. There are a lot of assets that, as I said, there was a very passive ownership that just sat there. There's a large loss to lease, a balance that is setting on there, and that's a loss to lease is just a difference between what the rent should be versus what current ownership is charging. And a lot of times ownership will trade off, pushing the rents to where they should be for a high occupancy rate, so they don't have to worry about, managing actively, proactively managing the asset. So these are the kind of things that we're looking for. They're right now, between now and the end of the year, we have $8 billion maturing in the multifamily market. And the majority of this, believe it or not, is going to start in October, and we're dubbing it Red October. For example. And we're going to
Can I take that? Can I take that, by the way?
Sure.
Okay, because I will. Well, but that leads me also to the other question too, is that with all of this coming due, we've already, I was reading the Wall Street Journal a couple months ago, and it talked about a gentleman out of Houston that had $500 million worth of properties, and 300 million got taken back. And then it talked about their investors and everything else. So do you think that there is going to be an opportunity to buy debt on these properties? And sort of a either a loan to own, or just buy the debt in general?
Yes, and we're already seeing that. Quite frankly, unfortunately, one of the byproducts of this fast, rapid rate hike has been that we've seen two of the largest bank failures in history in the last 24 months, I believe. And, as they were resolving those bank failures, there were loan sales involved there. And I know that you're probably aware of one where a large multifamily portfolio in New York City was transferred. And so we're going to see some of that. There's certainly people that there's a lot of dry powder on the sidelines looking for distress or opportunistic entry points. And, one of the ways is, as you said, buying the debt. The other is approaching the owners, directly as before the debt matures, and then working with that owner that may not have the experience to do a workout with a lender. And that way it may involve a haircut of the debt. But, it's a situation where both the owner and the lender would probably end up in a better situation than if they were to move that loan out there. Now, that's not to say, now this is more on an individual asset level. And, if as you're talking about the larger portfolios, obviously the loan sales are more viable on some of that. But, for the one-offs or the smaller portfolios, then, some of the smaller lenders, we're definitely going to see workouts, at the bank level. And that will involve, the good old fashioned short sale that, we saw back in 2009, with residential homes. And of course, we saw it also with commercial real estate. So we anticipate picking up some that involve what we call workouts. It's sort of a hybrid where you're not buying the loan, but you are working with a lender to negotiate a resolution that transfers the property and accomplishes all the parties, interested parties' goals.
Well, I'll tell you, this whole conversation with this, and it's very timely, obviously, like we were talking about a little bit before, that always go back to you make money on the buy. It really does. And it's what's your strategy? How are you going about it? And, the one thing about real estate, in my opinion, is that there will always be opportunities. And that really comes down to because of those that aren't as seasoned, don't have the experience of cycles, right? Or are just, hopping in because everybody else has started making money, thinks this is easy, stuff like that, right? And so, it creates opportunity. So, which is good for those that are, as I mentioned, ready for that and understand that. And I think we are going to be seeing some of that coming up. And I love this Red October, which I am gonna take from you, and we've got it on there. So, Rick Courtney, Essential Realty Partners, thanks so much. This was some great information. We appreciate you coming in and discussing this with us. And we'd love to have you back on the show here sooner than later.
Thank you so much for having me, DJ. It's been a pleasure as always.
All right.
Take care.